You close the door. So, welcome back to another episode of Ask Somebody Else. Ask Somebody Else is our weekly Instagram live where every week we talk to an amazing industry professional. Obviously, this week is like each and every other week. We're going to have another amazing guest on. You know he's already here straight away. Whilst we get ready, whilst we get him locked in, everyone say hi. Hope everyone's good. Let me know how you're doing. Let me see. Where's he at? Oh, we got him nice and punctual. We love that. We love that. So today I think is actually a day for serious people. How you doing?
Right, can you hear me?
I can hear you. Can you hear me?
I can hear you fine, yeah. How's it going, man? You good?
Good. I'm very well, thank you. And you?
Very good, thank you.
Good. So we have got the man himself, Shaz, on today. I've missed you on a number of occasions. I missed you during my Welsh tour as I was doing way too much running around. I didn't get to catch you there. I caught you very briefly at GVE.
GVE, that's
Savoys.
it.
GVE. Quick plug for Savoys because we love those boys.
Yep.
But it's good to have you on. You see, I was just explaining to everybody, basically, this is our weekly Instagram live section where we have a different industry professional on each and every week to answer some of your questions free of charge that you may have that are going to help to accelerate your property journey. So, Shaz, for people that don't know, can you tell them a little bit about yourself?
Yeah, of course, Gazzy. So, I'm excited to be on, actually. I am a finance professional, so I work in the finance side of things. I help property investors when they're looking for fundings, whether it's short-term bridging or development finance or longer-term HMOs, buy-to-let, service accommodation, anything wild and wonderful. So I don't really do like residential mortgages, homeowner mortgages. It's more the investors I deal with. And I guess the niche is working creatively, working quickly, just to give you, the investor, as little fuss as possible. You crack on with your investing.
That is really it. And that's why when people talk about like building out your power team, and it's very cliche, but effectively the ability to operate almost like a cash purchaser a lot of the time is what can enable you to get the deal across the line as a property developer or property investor. It doesn't always have to be something you're planning to build out or develop. It could just be a really good deal that you need to be in a position to move quickly on. So again, we always start as if, which is very true, I don't really know that much. So we always assume to get the questions rolling that I know nothing. So
Yeah.
explain for those that don't know, what is a bridging loan? I think that's a really good question to start
Cool.
with.
Yeah, so bridging loan essentially bridges the gap between a property that you want to purchase either very quickly or it's not habitable, or you're planning a fair bit of work to that property to add to value and pull that money back out. So if you're looking at a strategy like BRR, which is buy, refurbish, refinance, the first part of that has to be either cash or bridging finance. Some people say, well, look, the property I'm buying, it's habitable right now anyway. I'm just going to do a lot of work and remortgage it.
Yeah.
You still can't get a mortgage because, look, the way I look at it is, people get really pushy, is if we approach the mortgage lender now and tell them what your plan is, you're going to have an empty property for 3-4 months. You're going to be knocking walls through, and then you're going to sell it or refinance it away. Is that okay? They're going to say no chance. So bridging bridges the gap between you getting a longer term product and actually in the middle doing what you want to do to the house.
Okay, because I think, because for a lot of people, they think, oh, I'm just going to buy it on a buy to let. But effectively, like you said, what you're really doing, if you are buying a property that you plan either to leave empty for an extended period or to do just non-cosmetic work to that property, and that sometimes can be as much as just new kitchens and new bathrooms, that a lot of the time you're breaching the terms and conditions of your mortgage lender, because mortgage is a long-term product and a bridge is a specific bespoke short-term product fit for purpose to allow you to move on to that longer term product.
Exactly.
So that's what it's for. But give me, so that's why somebody would use a bridge. But how does a bridge differentiate, when it comes to rates? Like what are people paying on bridges when it comes to their interest rates?
Cool. So first of all, I always say to people, look, forget comparing it to a mortgage, because the costs, you're not comparing like for like. So if a mortgage right now is, let's say, 3% per annum, a bridging loan is typically about 0.8% per month. So over a year is quite a lot, but actually the whole point is, in short term, you're going to be in and out in 6 to 9 months.
Mm-hmm.
So you usually get charged a 2% arrangement fee, which gets added on or taken away depending on the lender. You get the interest rate of 0.8 or whatever it is percent per month.
Mm-hmm.
Some lenders do still charge exit fees, but really it's not. I'd say there's more that don't charge than do.
Yeah.
Uh,
My experience.
upfront fees are pretty similar to mortgages. You've got legals, valuation, and then if your broker's charging you a fee, you've got broker fees as well. So yeah, it's that interest. And what's really important for people to understand with bridging is the difference between the gross loan or the loan to value and the net loan.
Oh, that's
So
like, you read my mind, Shaz. I was gonna.
no, I love talking about this. So let's say your broker or even on the internet you've seen a lender that says we'll give you 75% loan to value.
Mm-hmm.
That's 75% gross. Now, what you actually get on your bank on day one depends how you pay the interest. So there's three ways really of paying the interest. You can either service it, which means you set up a direct debit and pay the interest each month. Now, to be honest, it's not very common because if you've got an empty property and then depending on how much you're borrowing, you've got to find 5, 6, 7, 800 quid a month for the interest, and you've got to pay your builder and all that kind of stuff. It's not really practical, so it's not very common unless it's a smaller deal. Then you've got rolled up interest. Now this is fairly simple. You get a slightly lower loan to value. You get 70% net on day one.
Mm-hmm.
All the interest and the fees just pay at the very end. So this is common for like large developments. It's better because you're paying interest on money you get in the bank, but the risk is you're paying from your profit. If you don't make a profit at the end, you might be in a tight spot. And then the last most common method, and this is where people look at it and think what's going on, is retained interest. So let's say you agree an overall term of 9 months. What the lender will do is work out, okay, over 9 months at this interest rate, you'd be paying 15 grand's worth of interest. Before they give you that 75%, they'll take that money away from your gross loan, so your net loan is lower because the interest has been retained. Now, often people say then, will I get a refund if I pay back early? Unfortunately not. The interest hasn't been paid, it's been retained just to manage the risk. So if you look at it this way, if you kept the loan for the full term, so in this case 9 months, you pay back your 75%. If you paid it back in 6 months, you pay back your net loan plus 6 months worth of interest. So it's a bit weird, it's a bit complicated, and that's why maybe it's worth having a chat with a broker. But it's worth understanding what your maximum commitment is.
Let's do a test.
Yeah.
I want to see right now. We've got sort of 50 people in here.
Yeah.
Who took away from that understanding the process of bridging loans? If you did take away from it and you feel like you're a bit more versed in understanding them, I want to see a thumbs up, that emoji. And if you didn't really understand it, thumbs down, or let us know why. Because obviously it's a lot of jargon. I think that's one thing about property. It can sometimes seem scary because you hear a lot of LTV, SPV, I don't know, MBC, all of these different things. You hear, these things, and maybe it doesn't necessarily resonate with you. So I think if you're not understanding it, let us know where you don't understand it. And, you can use the comments, you can use the questions, and hopefully we can shed light, because the reality is that sessions like this effectively are supposed to be helpful. If you're just hearing this, if anything, is putting you off it because it sounds too complicated, let us know why, because you've got 2 people that have been doing it for a long time. And I think maybe because I'm not I'm not the professional like Shaz, so I understand it from a layman's perspective. So effectively, you've got to look at it like this. When you do the retained option, the bank, we use round numbers. The bank will say they're going to give you a 75% loan to value, and assuming the property purchase was 100,000, that means that they're going to lend you £75,000, and you have to put in £25,000 of your own money, and that 75,000 is your gross loan. However, the amount they're going to lend you, they have fees they take off it, which is the arrangement fee, a percentage for starting the loan. So, for example, at the 75,000, if they charge you 2% of that, then that's going to cost you £1,500. That's a fee. If monthly, for argument's sake, for round numbers, we're going to say that it was 1% a month, and you have it for 6 months, that's then going to cost you another £750 for every 6 months. So then when they look at what they actually lend you, rather than you have to pay monthly, they take all of that interest in advance and lend you a lower amount, which means your loan to value might end up only being 68% because they give you 68,000 day one and they charge you in advance. Now, the good part about that is for somebody who touched on how a bridge is pre-qualified, is that you then don't have to meet as high earnings potentials to say that this is how we're going to cash flow it because you've paid it. So everything is risk and reward. You've mitigated your lender's risk by letting them retain the money, so they can then basically offer you slightly better terms effectively because they're not having
So like you
diligence.
said, in terms of risk, Kazi, the way it mitigates risk as well is if they're offering you 75%, I mean, we've got lenders do 80, 85%, but if they're offering that by retaining the interest, they know that even if you kept it for the full term, you're not going to go above that 80 or 85%. So even you know as an investor what your maximum commitment is on that loan.
Mm-hmm. And then somebody just touched on, do bridging lenders assess your personal income like mortgage lenders?
So I'm going to say yes and no. So what bridging lenders are most concerned with is what they call the exit strategy. So how are you going to pay them back? So if your exit was to sell, then your personal circumstances don't have any odds because you could sell a house through an agent. If your exit is to refinance or to keep the property, then they may just want to see, are you mortgageable? Do you have any kind of bad or adverse credit? They may even say, do you have like a decision in principle from your mortgage lender, which is a bit premature, but you can still get one. So no, bridging lenders don't really care. They care more about the exit. How you're going to pay them back? How plausible is it? How realistic is it?
And so this kind of brings me on quite nicely to sort of my next point, because we often hear in property people talk about SPVs, special purpose vehicles, properties that are set up day one to allow you to buy a property. But that means you're able to actually get a bridging loan in a brand new company. So what actually are the requirements to be able to get a bridging loan?
Fine. So yeah, you can have a brand new company that you set up today, set the bank account up and apply for a bridging loan in that company. It's not a problem. The reason is because you will be the director and main shareholder of that company, the lenders will underwrite you. They'll take a personal guarantee from you, take a charge on the company and a charge on the property. So really, in terms of requirements, the main things are proof of funds. So do you have enough money to get into the deal? And that's really important because when we just spoke about this whole interest thing, you've got to have a bit more than the 25% to get into the deal. Second thing is a plausible and kind of realistic schedule of works. So if you're saying I'm going to do a HMO conversion, it's going to cost 50 grand, they want to see a schedule of works or a fixed price contract that you may have with your builder or your project manager. They want to look at that and make sure it's realistic. Now, this will be given to the valuer as well. So the valuer will make sure it's realistic in their professional opinion, and they'll comment on the end value. So the three kind of figures that are important is the purchase price, the cost of the work, and the end value. Do all those things tie in together? Do they make sense? So it's all, I think with bridging, it's definitely all about the numbers. Can you get into the deal? Can you come out of the deal? Are you leaving money in? All those sorts of things.
And that's it. I think because for a lot of people, they go asking, can I get a bridging loan? But the reality is a lot of the time, so it all comes back to, does the deal make sense? Is there, enough meat on the bone that makes sense? If things did move, are you, mitigating the risk of the lender? So that's really the main thing. So if you are looking to potentially take out a bridge on a project, you should be able to demonstrate to the proposed lender that the project makes sense from start, middle, and end, i.e., the purchase price initially, your schedule of works in the middle, and then your exit strategy towards the end.
Can I just also mention, in terms of getting into the deal and proof of funds and source of funds, where bridging can be very handy is if you want to use investors' money or other people's money. So if you raise money off Instagram or whatever, however you do it, that's fine on bridging, but not on mortgages. But on bridging, they'll just want to see a loan agreement between you and the investor. Ideally, the investor can't have a charge on the property, but you can give them some of the security, like a personal guarantee. And here's the thing, right? So if I was an investor lending someone money, I want to be as hands-off as possible and say, like, here's the money, you've offered me this return, crack on. Lenders, and definitely the solicitors, will want to check for the original source and the proof of funds. So your investor may have to be slightly involved just to show 6 months or whatever with the bank statement to show where they got their money from. And they also have to sign what they call a deed of subordination. All that is a legal document that says, I, the investor, have no interest in this particular property. I'm just lending the money to this guy personally or this company. So it adds on to additional legal costs, but yes, you can use investor money. Lenders are keen that you, the kind of actual applicant, have got what they call some skin in the game. So they want you to put something in, but there's no kind of set hard rule. Even if it's a small amount, if you can say, well, this is my business plan as an investor. I'm going to use other people's money. It's all good. Just make sure your investor knows it's not completely hands off. There are things they are going to have to evidence.
I think that's really important and something we haven't spoke about enough, because a lot of people in here are going to be looking at raising investor finance, and I think that's great if you've built up, your shop window, whether it's through Instagram, social media, networking, all different things. You've been able to actually obtain investor funding. It's then great to have the money, but then how are you going to proactively be able to use that to invest in property? And I think loads of what you've just said are like loads of really good hints and tips about how you can get the deal across the line. There's another guy we had on once, a guy called James Owosu, I think his name is, from a company called Checkboard. So they've done really well, doing great stuff in the AML, KYC, and and also proof of funds. So sorry, that's a know your client, anti-money laundering. So they provide service. I think it's from as little as £3 for each individual check, and they do that. That also helps lenders, because you can say, look, this is how I pre-qualified my investor. Here's my know your client stuff. Here's their proof of funds. Here's their anti-money laundering. So I did to make sure I could take that money effectively. I think that's really important, because what you also want to be doing is making the job as easy for your broker as possible to make you as attractive to as many lenders as possible.
Yeah. Things to kind of avoid, because I've had this recently, is it's fine to look at different brokers, maybe give them the same scenario. That's your choice. But I would say try not to do that with bridging, because there's lots of lenders, but really, as a broker, we know these lenders are the best in kind of this market, and so on and so forth. Now, if a lender has the same deal come to them with the same client, but from different brokers, they get really kind of funny about it, because they're like, this client's just chasing interest rates. We're not really comfortable. They're not doing deals. So try and avoid doing that with multiple brokers. The other thing I want to add just before we go into this is about experience. So a lot of people say it's my first project, I'm going straight into a HMO conversion or commercial conversion or something similar. Lenders will ask about experience. So what has this investor done before? If you have zero experience, it's not the end of the world. They just will insist, and actually insist quite a lot, that your project manager has done at least 3 or more similar projects that they can evidence with figures and so on. So experience is not the be-all and end-all. It's important, but if you don't have it, just leverage off of someone else's experience.
And that's it where it's funny, because I used to hate the phrase power team. I used to hate it. Not enough of one of these Instagram property developers with a power with positive affirmations. However, that is the exact example of, if you've got a great project manager, a great architect on board who's going to project manage, or QS that have delivered loads of stuff, it means that you can leverage off their skill set. Which effectively means, okay, maybe you haven't done it before, but it's not your job to know everything, but it's your job to have the right people strategically positioned in the right places to allow you to deliver the project.
And also, back to what we talked about, kind of key tips. So things that make bridging lenders just say no thanks. To get a really good bridging deal over the line, like you said, Kazi, tell your broker everything on day one. So this is my proof of funds, but actually it's from these 3 people. That's fine. Just tell your broker. They can position that in a good way. What lenders don't like is when things change post-submission. So you've had your terms. You've gone to your broker. You said, this is my project. They've come back to you with terms that are usually approved by the credit committee. So the lender has gone to their credit team, said, this is what we've got. Are you happy yet? These are the terms. Now, if you suddenly change something on the deal, so your costs increase or decrease, suddenly you're getting money from someone else, that was a 4th person involved, all these kind of things, they just throw lenders off. What you've got to realise is, I'd say a good 70% of these lenders are not lending their own money, they're lending money from other people. So that could be other banks, other investment pools, or crowdfunding and so on. So if they've essentially sold the deal on and got the funding agreed, but something changes, it starts from square one. So try and get as much as possible nailed in and without any changes. Just be transparent with your broker. If there is anything you think is a bit unusual, just tell your broker straight away.
That's it. So we're gonna have these as three things as a broker. So
Yeah.
that's the first one is people changing, like moving the goalposts. Give me three things that make it difficult to either work with a broker or three things as a broker that just can frustrate you a little bit. So you've got people that are changing their minds. Give me two more.
I think the second one is what I mentioned before, is people who are fishing around, is the
Mm.
right word, with other
Or
brokers.
just
There's nothing wrong
chasing
with
it.
it. Chasing interest rates, yeah. And that could be going through different brokers. And bear in mind, guys, brokers talk. Like, you've had Sam Norris on here. Me and Sam
Yeah.
are in a WhatsApp group. We talk all the time, so we know what goes on. Um, but that could be if you've
Oh,
got...
who do you talk about? Is it Tej? I
It's
talk about
just you,
Tej.
mate. um, But yeah, that's one. But it could be that you're with one broker, but you're saying, oh, I've seen these terms, but my friend or my investor friend has had this. Can we not look at that now? The thing is, your investor friend's project may be completely different to yours. They may have more experience, so never compare what you've got with anyone else. Just I think when people say to me sometimes, is this the best we can get? And I'm just thinking, nah, I've held the best one back just because I want to, no one's got time to do that.
Yeah.
So trust your broker, I think, is what I'm saying on that one.
I think that's it because building a good relationship with your broker,
Yeah.
for me it means 90% of the time, like when those inquiries come in, they've answered 90% of them being like, I just need one up-to-date bank statement. They
Yeah.
queried this payment and they've asked for an updated schedule because this one's a bit outdated and that's it. But the majority of the work has been done. And I always kind of compare a broker to like having a personal shopper.
Yeah.
It's,
Yeah.
that you could, for example, go and wait in the line for the brand new like Adidas Yeezys that are coming out. And you maybe get them slightly cheaper. You get them at,
Yeah.
you know what I mean, direct from the source. However, what do you value your time at? Whereas if you go to say, look, this is what I want, go and get me exactly what I want. It's your broker's job to come back and deliver you the product at convenience, exactly when you want it. And I think that's the best analogy I've found for working with a really good broker.
No, that makes sense. I think the third one, Kazi, I would say is not nailing down or being transparent about the source of funds.
Mm.
So, you could present me your bank statement with the deposit and everything else in there, but actually just not say, just for whatever reason, not saying, by the way, this is money that 20 grand from here, 30 grand from here, 30 grand from here. It's because look, once we present to an underwriter, if we declare that information up front, it's just so much easier because it's like, yeah, we know this deal. If
Yeah.
they come back and say, by the way, 2 months ago there's like 60 grand coming in, where's that come from? That's probably an easy answer, but the fact that we didn't address it ourselves, it just puts
Yeah.
you a step back.
It's just transparency because the reality is, a lot of the time, not that you're putting your neck on the line for a client, but everything is relationship based. So you have relationship with your, what are they called? Like your
Business development managers.
BD or whoever it is, like from the bank or from the lender.
Yeah.
And like, you're like, look, no, trust me, I know this client, they're really good, X, Y, Z. And then when you come back and you say, actually, what are all these things? Then like, well, now it's affected your relationship and the speed in which that you can do deals. So we've basically got transparency, people just sort of fishing and shopping around, and people that sort of move the goalposts. Or what
Yeah.
stress you. Give me three things that you love as a broker. When people come to you and they're like, right, that's it. This is a great client. Going to work with them. What do you love as a broker?
I like it when people are organised and they send me PDF files, quite neatly labelled for everything that I ask for, but only what I ask for. Here's the thing, right? So a lot of lenders nowadays are quite tech savvy. They don't need you to send bank statements. You just click a link and it's open banking, all that kind of jazz. Unless you're asked to send something in, don't send it because one, I have to look at it. And if I don't need to look at it, I won't need to. But if it goes to the lender and the underwriter, because you've sent it in, they kind of have to see it, and it can open up more questions. So people who are organised, sending everything in without asking really why, they just trust you. I think trust is the big thing, like you said about relationships.
Mm-hmm.
They trust that you're asking them because you need it. That's the first thing. What else do I enjoy? I think people who can work at speed. So, like, people who work with me personally because I am very rapid. But one of the reasons you're getting a bridging loan is that it can be done in 2 to 3 weeks, right?
Mm-hmm.
But if you decided that you've had the valuation done, you've got the terms, it's with legals, and suddenly you're just shilling, why? I don't like chasing clients, and it's not about me getting paid or anything, but actually it's just like, what you're doing. Because again, Kazi, you mentioned relationships with the lenders. They want the deals to be funded. They don't make any money till it's funded. So people who are not as urgent or kind of time apparent as I guess everyone else is in the chain.
Yeah.
And lastly, not to brag on them, it's people who use the wrong solicitor. So I don't like those, but people actually understand you've got to pay the going rate for a good commercial solicitor to get commercial deals like bridging finance over the line.
Yeah.
I can't maybe count the number of deals that have gone, I won't say gone south, but have gone really slow because people just haven't got the right solicitor in place.
Yeah, or even people that use a solicitor, because we don't use them, but sometimes your solicitor's too busy and they tell you I'm busy.
Yes.
And just listen to them. If you turn around and go to I don't know, wherever you're going, go to get some key cuts, and I'm busy, it's going to take forever. Probably just better off going somewhere else because they're being honest with you. And the busy
Absolutely.
solicitor is probably not going to give as much attention to detail. I think other thing to just touch on with bridging, a lot of the time you are going to have to pay double legals because you're going to have to pay for the bridger's legals and also your own. So that is another cost to consider when you are doing your numbers. I don't think you should miss out on.
And then I would also just factor in when you come to the remortgage, if you're keeping that property, more
Yeah,
solicitor fees back then as well.
exactly. Okay, so we're going to go into some questions now.
Cool.
Some of our guests. Valentina, I've been seeing you in here for a long time, so I appreciate that you're always here every Sunday. G Valentino has asked: are crypto gains acceptable as a source of an investor, so i.e., the client's funds, and how would you provide evidence of this for the broker?
So I ask this question to every business development manager coming in: are you okay with people using crypto profits? And everyone says, yeah, in principle we can, and it's fine. But I'm like, okay, fine. If you're saying it's okay, that's cool. But what about your solicitors? Because they're the ones who are going to have to sign it off eventually. And I think that's where we're going to fall over for now. So crypto money coming in. If you've put, let's say, £20,000 in, and in 6 months there's £50,000 coming out, the initial 20 grand, that's probably fine because you can see that going in.
Yeah.
It's the in-between bit, the actual profits in that short amount of time. I think solicitors will struggle with that. So the answer I'm getting from lenders is, yeah, we're okay with it. But when I've said, do you want to ask your solicitor, they're all saying, well, we'll have to check and let you know.
So I think that is potentially, obviously, if you've got your own solicitor, obviously there's two sides of it because it's the lender solicitor, your solicitor. Your solicitor might be okay with it. Some lenders will allow the solicitor, if they're on the panel, to do the work for both sides. So potentially you can have a conversation in advance. But effectively, what you're trying to do is tick off as many things as possible as early on as possible. So I think it's really good that you're asking the question. I couldn't tell you these specific solicitors, but I know people have been able to use some of their crypto gains as proof of funds. I think it's effectively the more you can show as a track record of, look, this is how the money is made, as opposed to just, I had money in a crypto wallet and now I've got more money. If you can show your ownership, show your actual trades, I think you're a lot more likely to build a track record to be able to put the breadcrumbs together to show that this is actually a legitimate source of income.
I agree.
Let's see. Got a couple of questions. So pay your bills, please. We're all trying. Pay your bills, please. Has asked, do bridges that lend on market value take into consideration planning permission, and how would they calculate this added value?
Fine. So I think I understand the question. So just to make sense of it, most bridging lenders, the same as mortgage lenders, will lend off the lower of the purchase price or the actual value. So if you've paid more for something than what it's worth, they're lending against that lower figure. On the flip side, especially with bridging, where people say I've got something below market value, most lenders don't care. They'll lend against the lower of the purchase price or value. However, there's actually quite a lot of lenders now that will do what they call open market value bridging, where as long as the surveyor goes out and is happy, yeah, it's definitely worth X amount. If your discount is genuine, it's arm's length and so on, they'll lend against the value. So by doing that, you can
just
kind of...
Before you go on to the next bit, explain what arm's length mean.
What's that? Sorry, what?
What does arm's length mean?
So arm's length means it can't be... I guess arm's length means it can't be someone you are working with, like a business partner or a JV investor. So family's okay, even though family is an arm's length, you can do a family transaction. You can do, if you've had like a lease option and you're exercising that, that'd be fine as well. But it can't be business partners and those kind of things. Or distress sales as well.
What they're trying to do is realistically that is all about anti-money laundering, effectively,
Yes.
to make sure that you're not buying it below market rate just to save on tax. So, say if you're buying it, if there's a genuine reason that you're buying it below market value, they would take open market value, which means they would lend on the actual price as opposed to the amount that you're buying it for, which means in essence you could get a much better loan to value effectively based on the market value. That was the first bit. The second question, I think, will probably lead us on, maybe we'll speak about it a little bit later, development finance. But if you're buying somewhere, and let's say, for example, we used to use round numbers, you buy a property for £100,000, 5% loan to value. You then go out, you spend some money, it doesn't really matter the amount, you spend some money and you get planning permission to build another house on the side. And the GDV of the house goes from that £100,000 all the way up to, say 250,000, for example, or to improve the property in some way. Let's not say build another house. How do lenders look at that?
So, by getting planning permission in, it makes the project more appealing because there's less barriers for you to do the work and get to that end value. However, by getting planning, there isn't that much of an actual value increase at this moment in time. There's a slight increase, but not enough to change the deal completely. So planning permission, what that mainly does, it means your funding, so for development funding, which you said you want to talk in a second, is a lot easier because you don't need to wait for planning. What you'll find is lenders generally, when they do these kind of valuations, they'll look at current value, market value on a 180-day basis. If they had to sell the house in 180 days, 90 days in open market and so on, they'll usually go with the lowest figure of those. So with planning in place, it usually is a big benefit for deals that need planning to get the work done. Because if you think about it, without the work being done, that GDV doesn't exist. So they're unlikely to give you a higher figure for that.
Okay, fair enough. So I guess it's only really for really substantial uplifts in the planning. I.e., if you bought a car park for £100,000 very speculatively, and you got planning, and it's now the GDP is now 1 point something million, then it has an investor value that somebody would pay to make money for buying a certain price, but it has to be a real significant uplift for it to change. Then a slightly question now from Kay Loreen has asked, how this is one familiar yourself with all of the property market, and are there any particular books you recommend?
So, oh God, I don't want to mention him in this podcast, but the book.
No, mention them whoever you like.
The book I always give a lot of my new starters to start with in the office is Ted's book.
It's good. I actually started one of Ted's e-learnings. I can't remember which one it was, but I liked it. I like his e-learnings. I like his passion. Recommend Tej as much as you like.
But his book is good purely because it's relevant to what's going on now. He's only written it a year or two ago. He uses bridging himself without a broker, but he does cover off a lot of the common GDV, LTV, or whatever all that means. So, I would recommend TED Talks. What was it called? I don't know what it's called now.
I can't remember. So there was
TED Talks Guide to Buying.
Bricks and More or something like that. But there was one before that. But if you go to Tej, he's in my list of people that I follow. He's been is tej.talks, and then you can go to him. It was his first book. So he's got 2 books. It's the first of 2 books. Check that out. It's the first of the 2. Tell them Shaz sent you. Don't tell them Kaz sent you, because Shaz is so famous. He's got his own affiliate links. He will get a bonus.
Absolutely not.
But no, it's a genuinely good book. Jokes aside, I definitely recommend checking it out. We also did a giveaway of the book ourselves. So we spoke a lot about bridging loans. Development finance is something that a lot of people talk about. I think to a certain extent, not a lot of people understand that much in terms of how it actually works. So, and a lot of people almost use development finance and bridging loans very interchangeably. How would you, define or differentiate development finance? What is it for? When is it used?
So yeah, the way I'd look at it is if you are getting any kind of money from the lender to actually pay towards the work, towards property, whether it is a small kind of modernisation or a large-scale development, HMO conversion or anything, I would class that as development finance. So not all bridging lenders will do that, where they fund the cost of the works. So suddenly a lot of lenders are removed from the equation. But yeah, development finance is good. It's kind of based on the end value, but you're not getting all that money up front. So with development finance, typically it's about 75% towards the purchase, less the interest and so on that you've covered at the start, and 100% towards the work, but that's always done in arrears in stages. So if we broke that down, let's say the work's going to cost £100,000.
Yeah.
They'll look at your schedule of works to make sure it's reasonable, but they'll say, okay, fine, we'll give you 4 lots of 25k. You have to have enough money to start the work off.
You
and
have
then,
to have 25k day one as well.
as well as your deposit. But, I mean, these days, any good project manager or builder can work, on credit or on arrears if you show you've got a facility. But the lender will still want you to have that money just in case. So once the work's done, you send across the invoices. The lenders will then, this is where it gets expensive by the way, send across the invoices to the lender. They'll send an asset manager to visit to make sure everything's been done to standard. They sign it off and then you get the money. Each visit costs about 450 quid.
And that's to be fair, not bad. Like I've seen higher. I don't know if it's just because I'm London. I've seen up to like
Well, yeah, exactly. It can vary, yeah.
795, and if you're drawing down in 25k increments and it's a 400k build, that very quickly adds up to a significant chunk of money, which means you have to kind of consider obviously that in your total the finance.
Just to also add as well, so although it's 100% towards the development, it is normally capped at 65 to 70% of the end value or the GDV. So you have to be adding enough value So you have to be adding enough value to get all the funding.
Okay, so let's break this down.
Let's do some numbers, yeah.
So development finance, not so much numbers, so development finance is the finance that allows you to go and do the work on the property outside the purchase. Now that can be up to 100%, but normally it's a cap of 70% of total GDV is what their lending facility is. So when you take into account the money they lend you for the purchase, plus the cost, they're not going to lend you more than 70% of GDV. It's generally paid in arrears, so you need to have whatever increments you're paying in, whether it is in blocks of 20,000, 50,000, 100,000, you need that amount of money day one to start the works, and then they'll pay you once the work's completed. You will be charged for them to come and do an appraisal to make sure the works have been done standards. You need to make sure you're factoring your cost of finance. Now, a few quick fire questions for you.
Sure.
Can you get development finance without planning permission? Like, so i.e., if you were just doing, maybe a HMO conversion in a non-Article 4 area, 6 rooms, and it was just building regs, could you get the development finance without planning in place?
Correct, yeah. So if the development or the work you're doing doesn't need planning, then yeah, you can just get the development funding agreed straight away. If it does need planning, then you can still get the facility agreed in principle, subject to getting planning. What I tend to do is, every kind of area is different. If in your local area planning decisions are taking a month or two, then what you can say to the lender is, look, this valuation I'm paying for right now, the first valuation, here's my schedule of works for once I get planning. I want to include this scenario as well. This will add to the cost, but it means as soon as you get planning, you can say, look, you've had that valuation done already.
Yeah.
Now I want to draw down.
Nice. Okay, additional question. So, development finance in terms of the element of the lending is different to the initial loan. And you mentioned not all lenders that do purchase lending do development finance lending. Does it have to be from the same entity? So either you've taken a bridge with lender A, do you have to take the development finance from that same lender, or are you able to have two lenders?
Ideally, it's the same lender, only because let's say you had, I'm just going to name lenders because it's easier for me. Let's say you had Lendinvest.
You name names, you name whoever.
I'm name dropping. Listen,
There's no more text. Name whoever else you like now.
You can go to these guys direct. So Lendinvest, they will lend towards the purchase. And let's say now you wanted to get the development funding from Octane Capital. they're both going to want to have first charge on the property, right? First ranking charge. They're going to have the squabble. It's not going to happen. So to make this happen, you're going to have to repay your LendInvest loan, pay the interest and the fees all over again to go with Octane. So the best thing is start with Octane in the first place, and they'll do it in tranches as it works.
And that's it. Effectively, what that goes back to is understanding the whole journey of your project. Because if you understand that you're likely to need development finance, then you need to give your broker that information. That means they can point you in the right direction. That's going to save you paying on fees twice. And I think that's really what a lot of these conversations are about. There's a lot of jargon, there's a lot of, things that come up, not understanding. But the more you kind of are transparent and look, this is what I'm trying to do. Having the right people, whether it's Shaz, whether it's Sam, whether it's Tej, whoever it is you're working with, they're able to point you in the right direction and give you that advice. I think that's one thing that I say as well. Even when I'm doing like my consultation, saying like XYZ, the more information you give me, the more relevant the conversation is going to be able, to enable you to kind of kickstart your journey. So I think give people as much information about what you're trying to achieve, and hopefully that can enable you and them both be a success. Let's see, we've got another question pop up. Oh, this is quite an interesting one. So, then I click it. It's from... Wow, I'm so bad. Can you pronounce this? I'm going to go with...
Totaniora.
Totaniara. That's what we're going to go with.
That's it.
So, can you get development finance for a residential property that you wish to live in?
Yes, you can. So you can get bridging finance for property you want to live in. It becomes regulated, so it becomes a regulated loan. All that means is for the broker, a lot more paperwork and a lot more red tape to follow on the back end. And there's, again, less lenders who do regulated development finance. For this kind of deal, your income will be important, because to exit that bridging loan, you have to then get a residential mortgage. So can you get a residential mortgage for the amount you've added the value for to clear off the loan? Does that make sense?
Yeah.
Yeah.
So people are going to, effectively, it's back to what's your exit, because it's great to say, okay, anybody can go and get a development loan, because it's great if, for example, you've got a house that's worth 5,000 and you're currently a LTV. It means that, okay, great, if you get a development loan for 100,000 and it's then going to be worth £900,000, pay back your development loan, you're going to have to then borrow potentially £650,000 from a bank. Now, does your affordability, does your current level of income of yourself and your partner or whoever the owners of that property, do they meet the earning requirement that a bank's going to see that, are you able to do that effectively?
Yeah. So this is what I mean. So any kind of regulated loan, definitely a lot more thorough and a lot more paperwork, a lot more questions, but that's because it's your main residence that's in question. Yeah.
So effectively, they're looking at you they're looking at your affordability as opposed to just the deal as a whole, which means there's more information from you as an individual that's required. That's good. It's good. I think we're going to wrap up around here. Shaz, really appreciate having you on. If people want to reach out to you, if they potentially want to get a quote, want to start lending, they want to move along on their journey, where can they find you?
So I think Instagram is a good starting point, and then on my profile, all my links are on there. You can book a call in or whatever.
Good. Anybody else? You mentioned Tej a little bit more. You mentioned him a lot. Just talk about Tej for a little.
You mentioned Tej. No, there's loads of. I mean, Alfred, I think, joined the room at some point. Alfred's
really well. The other good thing I was going to say for a lot of people that are in here, like, just make sure you check the people that join. Like, I've seen Alfred joined at a point. I saw the guys from Boxall Homes. They're going to be on our recent development tour site. They're doing some good stuff in South Wales. Who else did I see? I saw Abby Anaru in here earlier. She does a lot of rent to rent and just bought her 5th property. I saw loads of people. So if I haven't just mentioned you, it doesn't mean that you're not great. It just means that I can't remember. But you can, comments. I read comments and they always throw me off, like random. But I appreciate you guys for coming on. Definitely gonna have more conversations like this. We've got another one next Sunday, same time, same place. We've got the development tours that are coming out on a weekly basis. They come out every Thursday on Instagram. We've got the podcast, which I know we're going to get Shaz on at some point to talk numbers, to really understand deals. They come out every Friday. We had a little hiatus, we had a little gap, but we're coming back strong next week. Next week, we've got Connor, aka Mr. Luxury Property Dubai. He just sold the most expensive villa at $17 million.
Wow.
You know, he sold that. The commission structure over there, like selling Sunset. You're on percentages, not percentage of percentages. That's great. He did that at 24 years old. So if you want to understand about it, make sure you get that episode that's coming out. Again, everyone enjoy the rest of your weekend. Chaz, thanks for coming on. Catch you all
Thanks
very
for
soon.
having me. Thanks for having
Take care, bro.
Cheers.